Grace Peters then is EMEA Head of Investment Strategy at JP Morgan Private Bank. And Grace, I was just fleshing out the first comment on your notes ultimately here. So how worried do we need to be that this uneven recovery could undermine some of the reallocation to cyclicals that we've seen?
Well, thank you for previewing the note, and certainly it's essential that we navigate this crossroads ahead of us in order to continue on this path to recovery. If we think behind us, the first half of the year really demarked by the strength and the speed of the recovery at a headline level. Going forwards, we need to navigate global growth slowing and also central bank policy becoming less supportive. And as you referenced, at a headline level, that growth has been incredibly strong and fast, but these divergences below the sector, whether they be by geography or whether they be by sector, also are going to come to the fore ever more in the second half. When it comes to the geographic divergences, I think a lot of that is around the growth policy trade-off. China first in, first out. Now we're looking at actually, will the credit conditions there lead to a slowdown in growth? This is what the market fears. We actually think that China is a super place to allocate capital to, an essential place when you take a longer term view. When we think around the world, Europe, a laggard when it comes to the reopening, that's now taking shape, and you're seeing European assets outperform, and emerging markets may follow that. So we think that all of this speaks to having broader geographic diversification when it comes to accessing the recovery, but also what life looks like beyond COVID. And as you mentioned also the sector, spreads that we've seen below the surface is as much about the reopening, but also what the next normal will be when we emerge from the pandemic.
It sounds like a very unpleasant cocktail for the second half of the year, as you stated. What then is the risk around credit impairments or any uptick in credit-related stress? Because if you're right, I'd be inclined to move to a position where I can perhaps generate income rather than relying on capital gain. But I don't want to be stuck in a company that could go bust if we start to see interest rates go up.
We think that the economy will be able to navigate these headwinds and the divergences. So actually, whilst we talk about the mid-cycle phase where we think we're moving to now being a period of lower returns, we still think that you get paid to take risk. We still prefer equities. We would have pro-cyclical asset allocation, and also both at the asset class level and also within asset classes. So we aren't overtly concerned by the credit cycle. We would put incremental money into cyclical equities, which, as you highlighted just before I started speaking, we've seen a stalling of equity markets, including some of those cyclical parts of the market over the last month, as the market's been digesting the concept of peak data. But we do think that bond yields are going to ultimately start moving higher, and that will ultimately support financials, industrials, semiconductor companies that are the parts of the market most geared into rising bond yields and still into a healthy economic outlook. So we think actually that growth can continue at above trend pace through to the end of 2022, but we do just need to be mindful of headwinds, not getting complacent after we've had this stellar run of positive macro news and very solid market performance, and acknowledge that from here returns from equities are more likely to be mid-single digit in line with historic averages.